Hey everyone, welcome back to the channel. So the other day I was browsing Twitter and I came across this hot take by my buddy Karan Granati, who is a fellow member of Punch Card Investing. If you haven't already subscribed to that channel, please go and do that. It's a weekly live stream where we talk about all things value investing. Anyways, Karan says, I genuinely don't understand why people choose to invest in real estate over REITs. Factor in the stress involved and there's no competition. Well, as someone who invests in both real estate directly and REITs, I think I can offer something to Karan's concern. Why would people invest in real estate directly when you have REITs right there, a much more passive approach to real estate? Why don't you just take that? So let's try to shed some light on why someone would be crazy enough to invest in real estate directly as opposed to going for something like a REIT. Now, some of these advantages might be more obvious than others, but let's get into them. The first one I wrote down here was taxes. Taxes will kind of depend on each person's individual situation, and you could say it applies to companies as well, but let me tell you what I mean about taxes. For a real estate investor buying real estate directly, at least in the US, and again, every person's tax situation is different, so take this with a grain of salt, but in general, there are a lot of great personal tax benefits to someone who owns real estate directly, namely depreciation, where you can actually write off the value of the property against the income that the property might be throwing off. And if it's on your personal taxes, you can write it off against your other income as well as a business loss. And this is before we get into the host of other deductions like the interest deduction. So any interest you pay on your mortgage often can be deducted away. And that's in addition to the actual expenses you might spend on the property, whether it be for expenses in managing it or for capital expenditures. Often these things can be deductible. And there are ways to accelerate spending these deductions so they're even bigger towards year one with something like a cost segregation analysis, which is especially popular on bigger commercial deals where spending the time and money on the accountants to actually run through this whole process. Often you're bringing engineers out to say, hey, these parts of the building should be depreciated even faster than the rest of the building. And that takes a bit of complexity to actually get done. But point is, there are lots of different tax strategies within real estate. And that's both on the residential side, if you're investing in single family homes or something like that, all the way up to the commercial side, not just in residential, but in office, retail, whatever it is. Many of these deductions exist, at least in the US. Now compare this to REITs, which generally are very tax inefficient, at least for the shareholder. REITs themselves as a company do get some tax advantages in that they don't have to pay corporate taxes by filing with their REIT status. But in order to keep that REIT status, they do have to meet a few requirements, mainly paying out their income as dividends mostly. Generally speaking, they can't just take all this cash flow and hoard it. They have to pay it out as a dividend. That's typically how REITs work. And in return, they don't have to pay corporate taxes. But that's not where it ends, because shareholders themselves will not get special dividend tax treatment like they might with many other dividends out there. It's called a qualified dividend, where it actually gets treated at a capital gains tax rate, usually which is much lower than your income tax rate. So what this typically means is that REIT dividends are taxed as ordinary income, usually not as capital gains or some preferential dividend tax rate. That is usually what happens. Again, talk with a licensed professional. Karan is in the UAE, so he probably has a lot less taxes to worry about, generally speaking. But still, if you're investing at the company level, these tax advantages will apply too. After all, a REIT can use depreciation and the many deductions already listed off, most likely. So you're getting it at the company level. It's not as though that value is completely lost by not having it. But that's just one potential advantage of investing in real estate directly. You get to keep all those tax benefits for yourself, and that can really offset a lot of your other taxes that you might have on your personal income return. It totally depends, again, on the specific situation. But let's move on. The second factor that I wrote down here are debt options. And this, again, will kind of depend on where you're coming from. This is going to be very US centric, but typically with real estate, it has some of the best debt terms out there compared to many other types of loan products. And this is because, in large part, subsidies from the federal government in many cases. If we're talking about residential, you have Fannie Mae and Freddie Mac that subsidize mortgages heavily. They buy them up, and then the Federal Reserve will then buy many of those mortgage-backed securities that the entities create. And that is a big way to subsidize the mortgage industry at the expense of anyone who does not have a mortgage. So the rich get richer. But on the commercial side as well, it's often quite similar in that a lender will issue a commercial mortgage, and then that mortgage will be issued into a mortgage-backed security. But on the commercial side, it usually isn't much different, since the Federal Reserve owns half of all commercial mortgage-backed securities out there. So they own half the market, and that that is pretty crazy. But what this typically means is that loan terms for real estate debt are typically much better than other types of debt out there, partly because of these subsidies and also because the collateral itself is often highly sought after. It's a lot more predictable than many other types of collateral. In my case, I take advantage of the great terms on owner-occupied loans. In the house I'm living in right now, I only have to pay 2.99% interest over a 30-year fixed terms. And those sorts of terms, at least fixed over 30 years, are typically going to be much harder for even large commercial REITs to get, because typically those debt terms that REITs can get on the commercial side are going to be more like 5, 10, or 15-year terms, and then there's a balloon payment or something happens to the loan where it becomes variable. So you don't usually get that super low interest rate that's fixed over 30 years. That's pretty rare, but it's very easy to get, comparatively speaking, when you're talking about an individual investor buying residential properties in the US. But if you want to go the commercial route as an individual investor, of course you can do that too. You still have the flexibility. So it's not as though buying REITs is the only way to get into commercial property. If you play your cards right, maybe you raise some money, you can certainly buy commercial real estate yourself. That is an option. That's something that I'm looking to do in the near future, buying an apartment building, probably with some partners, and then we could add value to the property by increasing the NOI or reducing expenses, increasing income. That is typically how commercial real estate is valued. It's based on the income it produces rather than just sales comparables as it is on the single family home side of things. But anyways, debt options are typically quite abundant when it comes to real estate investing as a direct investor. Not that REITs can't take advantage of at least some of these great mortgage products too, but as an individual investor, you have the advantage of potentially using owner-occupied loans and also have the ability to write off the interest potentially from your taxes, going back to the tax advantage I mentioned earlier. Now, those two things, taxes and leverage, were probably pretty obvious to you if you've been around the real estate game at all or you've studied it at all. You probably knew that that was going to be in there somewhere. But let's talk about this at a higher level and kind of a risk-reward trade-off, the control that you have when it comes to investing in real estate. When you own a property directly, you have a lot of flexibility for as to what you can do with it. And there is a lot of value there depending on your core competencies. If you know what you're doing as a real estate investor, you can create a huge amount of value compared to just parking it in a REIT, which might be very, very diversified, might not be able to create massive outsized returns compared to what you might be able to do if you added value to a property yourself by doing some repairs, maybe doing the repairs yourself, hiring someone else to do it. There are lots of ways to increase the value of real estate yourself. Now, this isn't to say that REITs don't do the same thing in many cases. Often they are going to reposition properties and add a lot of value along the way. But keep in mind where you might be in the pecking order when it comes to being a REIT shareholder versus being a direct real estate owner. When you own the real estate directly, you are the owner. You get all the benefits. Of course, you get all the risks as well. But as a REIT holder, you typically have less risk, but you're also typically going to have much less reward. You're most likely not first in line after we're talking about fees, any promote that the actual REIT manager might get. You have share-based compensation potentially, which could dilute shareholders. You have special dividends that might be issued to preferred shareholders if you are not one yourself. So there are lots of different ways that you are not going to get paid before other people get paid when we're talking about a REIT. But that comes with less risk. I'm not going to try to discount that. The risk as a direct real estate owner is very obvious. If you default on your payments, whether it be for taxes, whether it be for your mortgage if you have one, that is a huge risk. You could lose that property. It's going to tank your credit. Whereas as a REIT holder, the only risk is the money that you put in. You are a common shareholder, most likely. I'm not talking about special types of shares where you might be on the hook for something, but as a common shareholder, the risk you have is you lose your initial investment, and that's pretty much it. When you're a direct real estate owner, even if you own something in an LLC, the fact of the matter is you are liable for things that people do on your property, whether it be you or your business, because if someone gets hurt on your property and you own it in your name, they're going to be able to come after you most likely, and if your insurance doesn't cover it, you're still on the hook. You got to pay for that balance. Same goes for a business. They might not be able to come after you personally, but the business is going to be on the hook, and it might bankrupt the business if the claim is big enough and you're not properly insured. Or as a common shareholder in a REIT, you're not going to have personal liability for anything bad that happens to the REIT itself. You might lose your initial investment, but you're not going to have some judgment against you just by nature of being a common shareholder. But Karan mentions this stress point, which is important. If you're buying property and you're self-managing especially, this is a huge concern. And it really is, coming from someone who did property management for their career right out of school, school, it is definitely quite intense. You have a lot of tenant issues that come up potentially. It depends on your tenants, of course, and how many units you're managing. If you just have 1 or 2 units, it probably wouldn't be that stressful, but you never know, because usually what happens is 20% of your tenants will give you 80% of your issues, and those 20% of your tenants can really take up a lot of your time, and it can be very stressful. You're juggling a lot of issues, and you never really know when an issue is going to come up if you're managing yourself. Now, I just had a problem with my primary residence. The basement flooded within 2 weeks of me moving in, which was by no means fun, but it was manageable. Now, if I had a property manager on the site, if it was a rental, which is what I've done with my other 2 properties, I've handed them over to management so they are dealing with the day-to-day issues. If I had a manager for this property, I would just tell them, hey, we got to get this fixed, throw some money at it, and then you're done. If you hire a great team, you take a lot of the stress out of real estate investment when we're talking about direct real estate investment, because that's essentially what you're doing with a REIT. You are kind of paying for a team to manage your real estate holdings. In this case, it's probably a larger commercial portfolio, and they're paying you dividends each month in return for you buying into the company. And this concept applies well beyond just real estate. It goes to business ownership in general. You could pose the same question to Karan. Why would you start your own business at all if you could just buy other people's businesses via stocks? It's really the same concept when it comes to REITs versus direct real estate ownership. It's the flexibility, it's the control, it's the potential tax benefits, and it does really come back to your core competency. If you think you are a competent real estate investor, you probably can produce pretty big returns in real estate. If you're a competent business owner, you could probably produce outsized returns as a business owner versus actually going into the stock market and buying shares of someone else's business that you wouldn't be running. And it definitely is up for you to decide how you want to run that business. I definitely try to run my real estate business much more passively. I hire a good team. I get property management, local property management that can deal with the day-to-day issues. Ideally, they have a maintenance team as well that can deal with smaller issues without me having to bother searching for some handyman or something, because they have one in their staff. That's something very important that I look for in property managers. And that's what I have on my 2 rentals that have managers. They are my resource for the day-to-day issues, and I'm only spending a few minutes per week on these properties at most, even when there might be something that happens. If a fridge needs to be replaced, which I did recently for my Indianapolis property, just have to send a couple emails, give them the okay to buy a fridge, and then we're done. The hard part's in the initial phases and getting that set up, finding a good manager, getting a good deal, of course, buying the property, negotiating, coordinating a rehab, or you might bring on contractors. That could be another source of struggle towards the beginning. But once you get that thing in motion, you really can scale it in a big way if that's something you're looking to do. Or maybe you're not looking to scale it and you just want to have a nice little portfolio that is pretty much on autopilot because you created good systems. And again, this applies to pretty much any sort of business that you might create. So Karan, let me know if that addressed your concern. Why would anyone invest in real estate directly when you could just buy REITs? Ideally, this answered that question. Please let me know in the comments below if you happen to see this. Anyways, that's all I've got for today. So if you like this video, please like it. This is how it helped the channel out a lot. And if you like this sort of content about investing and personal finance, be sure to subscribe since I put out new videos every single week and wouldn't want you guys to miss out. But until next time, take care.